This video is for informational and entertainment purposes only. Nothing discussed here should be considered financial advice. All trading and investing carries risk. The hosts and guests are not financial advisors. Always do your own research and consult with qualified professionals before making any investment decisions. Past performance does not guarantee future results.
Hey everyone, ready for a deep dive into something really interesting? We're talking cryptocurrency today, but with a twist. We're going beyond the hype and asking, can you really use machine learning to find profitable opportunities?
It's a question a lot of people are asking, especially with how crazy the crypto markets can be.
Yeah, for sure. So for this deep dive, our source is a research article. It's called Statistical Arbitrage in Cryptocurrency Markets.
Oh yeah, I've seen that one.
Yeah, it was published in the Journal of Risk and Financial Management.
Pretty legit, right?
Definitely a reputable source.
Okay, so what makes this research so cool is that it looks at statistical arbitrage. And I know that might sound kind of intimidating, but it's not about like timing the market or anything like that.
Right. It's not about trends or getting lucky.
Exactly. It's about finding those tiny little mispricings in the market that, most people wouldn't even notice.
And that you can exploit with algorithms.
Okay, so before we go any further, can you explain what statistical arbitrage is, in a way that even I can understand? Sure, think of it like this. You're walking down the street and you find a $5 bill just lying on the sidewalk.
Okay, free money. I like where this is going.
Right. Well, statistical arbitrage is kind of like that, but in the financial markets. You're looking for those tiny inefficiencies where prices are out of whack, even for a short moment, and then you capitalize on it.
I see. So it's like finding those little hidden treasures that everyone else is missing. Okay, so this research article, what were they actually trying to figure out?
They wanted to see if machine learning could predict which cryptocurrencies would do better than the average, over a 2-hour period.
So not just whether a coin would go up or down, but if it would outperform all the others.
Exactly, a much more nuanced approach.
Yeah.
And to do this, they use something called a random forest.
A random forest? That sounds more like something out of a fairy tale than, a financial model.
It might sound a little whimsical, but it's a very powerful machine learning algorithm. Imagine a forest full of decision-making trees, each looking at the data in a slightly different way.
Oh, okay, I'm starting to get it.
And then they all kind of vote on the most likely outcome.
So instead of one single prediction, you have this whole committee of trees weighing in.
Precisely. And they fed this random forest a massive amount of data. We're talking minute-by-minute price and volume data for 40 different cryptocurrencies, all the way from January 2018 to September 2018.
Wow, so they really crunched the numbers on this. So how did they actually turn all that data into a trading strategy?
Well, the model ranked all the coins based on, how likely they were to outperform the average. So imagine a list of all 40 cryptocurrencies, and the model's like, okay, these top 3 are most likely to go up, and these bottom 3, those are probably going to go down.
Got it. So then they simulated buying the top 3, going long, and betting against the bottom 3 by short selling, a classic long-short strategy.
Exactly. They were trying to profit no matter which way the market moved. But to make it realistic, they included trading costs, and they only traded when there was enough volume, to actually buy or sell.
Makes sense. I mean, you could have the best algorithm in the world, but if you can't actually buy or sell at the price you want, what's the point? Liquidity is huge in crypto.
Absolutely. So, are you ready for the results?
Hit me. Did it actually work?
It did. The strategy generated an average return of 7.1 basis points every day, and that's after taking those trading costs into account.
Okay, so small, consistent gains. But those could add up over time, especially with how much crypto prices can jump around.
Exactly. And to put it in perspective, it beat just holding Bitcoin or even a diversified portfolio of all 40 coins by a lot.
Wow. Okay, that's impressive. But this raises a question for me. If this model can consistently find profits, does that mean the crypto market is not as efficient as people think?
It's an interesting point. It does challenge the idea of perfectly efficient markets, where prices reflect all available information instantly. If it were truly efficient, these opportunities wouldn't exist.
Right. It's like if everyone knew the $5 bill was on the sidewalk, someone would have already picked it up.
Exactly. So, it's possible that crypto, being newer and less regulated, might be less efficient compared to, say, the stock market.
Makes sense. So what was the model picking up on? Was it some super complicated blockchain analysis or something?
Actually, no. The most important factor was the coin's price movements over just the past hour.
Really? Just the past hour? I would have thought it'd be looking at tons of data points, like trading volume and social media sentiment and all that.
Right. It is interesting. It seems the model might be capitalizing on short-term price reversals, like buying a coin that dipped a bit, hoping it'll bounce back.
Okay, starting to get the picture. But before we all run off to build our own crypto trading bots, we need a little dose of reality here, don't we?
Definitely. While these results are exciting, there's some important limitations to arbitrage that we need to consider.
Like what? Spill the beans?
Well, speed is everything. The study found that even a few minutes delay in executing a trade made a big difference in the returns.
That makes sense. Crypto moves so fast. Those price differences could vanish in seconds. You snooze, you lose.
Exactly. And then there's the issue of liquidity. Could you realistically trade large amounts of these coins without moving the price yourself? That's something to think about.
Right, you might end up pushing the price up just by trying to buy. It's like the old saying, if it seems too good to be true, it probably is. Anything else we should be aware of?
Well, short selling constraints. It's not always easy to borrow and sell coins you don't own, especially with cryptos still developing regulations.
So even if your model's perfect, you might not be able to actually make the trade.
Exactly. These are just a few examples of why statistical arbitrage, even with the help of machine learning, can be a pretty tricky business.
This is all pretty high-level stuff. What does it actually mean for someone who's, just starting out in crypto?
That's a good question. It boils down to this. There may be opportunities to profit in the crypto market, but it's not as simple as following the hype or, buying whatever coin is trending on Twitter.
We are definitely not giving financial advice here.
Definitely not. This research shows there might be more sophisticated approaches to trading crypto, but it also highlights how important it is to be careful, do your research, and understand the risks.
I'm getting the sense that there's a lot more to unpack here. Like, what does this all mean for the future of crypto trading? Are machines going to take over the markets and leave us humans in the dust?
I wouldn't go that far. Machine learning is a tool, a powerful one, but still just a tool. It takes human expertise to design the algorithms, interpret the results, and ultimately make the trading decisions.
So it's more like a partnership, right? Humans and machines working together to navigate these complex markets.
That's a good way to put it. And while this study was limited to a specific period and group of cryptocurrencies, it brings up a really important question. But maybe we should save that for after a quick break.
All right, so let's get back to that question you brought up about the efficiency of the crypto market. I mean, it's a big one, right?
Yeah, for sure. This research, at least for the time they were looking at, shows that there might be some inefficiencies, enough that this statistical arbitrage strategy could actually work. But I mean, does that mean crypto is just like inherently less efficient than something like the stock market?
Yeah, that's a really good question. I mean, crypto is still pretty young, right? And way less regulated. Plus, we see these huge price swings all the time.
Exactly. And those factors, I think, could definitely contribute to a market that's less efficient, where prices don't immediately reflect like all the available information.
So there might be more opportunities for these algorithms to find those profitable trades.
Yeah, potentially. But it also makes you think about how we actually, how we value these cryptocurrencies. I mean, if we can predict these short-term price movements, does that mean we're not really valuing them based on their, long-term potential?
Or are we just kind of like caught up in the hype, right? Just chasing those quick gains. It's an interesting debate. I don't think there's a clear answer yet.
Yeah, I agree. I think it goes to the heart of the whole crypto thing, Is it a revolutionary technology, or is it just a speculative bubble? Or maybe it's a little bit of both.
And if it's both, how do we even begin to navigate that, right? I mean, this research gives us a glimpse into how we can use data and algorithms and stuff, but it's just one piece of the puzzle.
Oh, for sure. And we also have to remember that this study looked at like a very specific time period and a specific group of cryptocurrencies.
Mm-hmm.
Things could be totally different now.
Yeah, crypto is constantly changing. So what does this all mean for, the average person who's just kind of starting to get into crypto trading?
It means that while there might be, opportunities to profit, it's not as simple as just, buying whatever coin everyone's talking about on Twitter.
We are not giving financial advice here.
Definitely not. This research shows us that there might be like more sophisticated ways to trade crypto, but it's so important to to be careful. Do your own research and make sure you understand the risks.
It's like you said before, right? It's not just about finding a $5 bill on the sidewalk. You got to know where to look, how to pick it up, and if it's even real in the first place.
Exactly. And even then, there's no guarantee there's going to be another one there tomorrow.
So for our listener, what's the one thing we want them to take away from this whole discussion?
The crypto market is, it's fascinating and it's complex. There might be ways to use data and algorithms to your advantage, but it's so important to be careful, do your research, and understand the risks involved.
Well said. This deep dive has been, it's been really eye-opening. And for those who want to learn more, we'll link to the article in the show notes. It's got some great info.
Yeah, good idea. But the researchers explain everything really well, like how they did it and what they considered and all that. Yeah. Definitely worth checking out if you're, interested in the technical side of things.
For sure. But even if you're not a data scientist or whatever, I think there are some really important takeaways here.
Totally agree. This research shows us that the crypto market, even though it's exciting and could potentially be very profitable, is also, it's incredibly complex. It's not about getting rich quick. You need to be thoughtful, you need to do your research, and you need to manage those risks.
Couldn't have said it better myself. And it'll be interesting to see how, as these machine learning algorithms become more common, how they impact, the crypto world going forward.
Yeah, like you said earlier, the barrier to entry it's getting lower and lower. This could potentially level the playing field, right? And give individual investors access to tools and strategies that only, big institutions used to have.
But it also brings up this whole question of, human judgment. Are we going to become totally reliant on algorithms to make our investment decisions? Or will there always be a need for, human intuition and expertise and all that?
That's a great question. And honestly, I don't think there's an easy answer. It's probably going to be a balance, right? Between using the power of technology, but also, keeping that healthy skepticism.
Well said. So for our listener who's been with us this whole time, what's the one key message we want them to remember?
I think it's this. The crypto market is it's fascinating. It's changing so fast. It's got huge potential, but also big risks. And, we've seen with this research that there are ways to use data and algorithms to, maybe find those profitable opportunities, but you got to be smart about it. You got to have a balanced perspective. You got to do your research, and you just got to keep learning.
I like that. Couldn't have said it better myself. This has been a really interesting deep dive, and hopefully it's made you a little more curious about, this whole world of crypto.
And we always encourage you to stay informed, keep up with what's going on, and don't be afraid to ask those tough questions.
Absolutely. So thanks for joining us on this intellectual adventure, and until next time, happy investing. It really is. And for anyone who wants to, really dig into the details of this research, we'll be sure to put a link to it in the show notes.
Good idea. It's well written. The researchers do a good job of, explaining all the technical stuff, like their methods and all the different factors they considered.
Yeah, it's a great resource if you're, if you want to get into the nitty-gritty.
Definitely.
But I think even for those who aren't, data scientists or whatever, there are some really important takeaways from this.
Oh, absolutely. It shows us that, the crypto market, as exciting as it is and as, potentially profitable as it is also just incredibly complex.
Yeah.
It's not a get-rich-quick scheme. You really got to think carefully. You got to do your research, and you got to manage your risk.
For sure. And as this machine learning stuff, these algorithms, become more and more accessible, it's going to be fascinating to see how they change the crypto world, going forward.
It is. Like we were talking about before, that barrier to entry is getting lower and lower. And this could, it could really level the playing field, give individual investors access to these really powerful tools that, before it was only the big institutions that could use them.
Right. But it also, it makes you think about the role of human judgment, right? Are we all going to just totally rely on these algorithms to make our investment decisions for us, or will there always be that need for human intuition, expertise, all that?
That's a really good question. And I honestly don't know that there's like a simple answer. I think it's probably going to be this, this kind of delicate balance between using technology, taking advantage of what it can do, but also keeping that healthy skepticism that we as humans can bring.
Yeah, well said. So So for our listener, who's been on this journey with us today, what's the one key message that we want them to take away from this whole deep dive?
I would say it's this. The crypto market it's fascinating. It's changing all the time. It's got like huge potential, but also, some big risks. And we've seen from this research that there are ways to, maybe use these data and algorithms to find those profitable opportunities. But you got to be smart about it. You got to have that balanced perspective. Do your own research. Never stop learning.
I love it. Couldn't have said it better myself. This has been a really, really fascinating deep dive, and hopefully it's piqued your interest a little bit, in this whole world of crypto.
Yeah, for sure. And as always, we encourage you to, stay informed, stay engaged, keep asking those tough questions.
Absolutely. Thanks for joining us on this intellectual adventure. And until next time, happy investing.